Hey, what's up, everyone? Welcome back to my world of stocks. We have now, of course, begun earnings season for the second quarter of this year. So, what I'll be doing for the next few weeks is giving you an earnings weekly recap every Saturday, just kind of rapid firing off for you the biggest earnings reports that kind of catch my eye for the week and letting you know how those stocks performed. Should be a ton of fun. This week, we've got reports from Taiwan Semiconductor, BlackRock, Netflix, some big banks, and more. So let's not waste any time, guys. I can't wait to jump into this with you. Let's go ahead and jump straight into it. All right, so kicking things off here with Monday, well, we had BlackRock report, the biggest asset management company in the entire world with over $10 trillion of assets under management. Now, this is really one of the most influential companies out there with their hands in pretty much everything in terms of investment. And yeah, they had a pretty good showing this quarter with sales growing by 8% in that second quarter. And although that was just a tad bit short of expectations, well, net income profits actually beat with also close to 10% growth year over year, which is very impressive for their already large size. A big reason for that strong performance was due to their iShares ETF platform having a record-breaking net inflows in the first half of the year. That's, you're probably familiar with iShares, but that's kind of like their bread and butter. I'm pretty sure iShares is the most used ETF issuer in the entire world. So basically they had a record-breaking first half of the year. Everyone kind of buying into iShares ETFs. It's extremely popular at this point. In terms of guidance, though, and for the macroeconomy, well, they didn't really give any kind of guidance, but they did say that they are currently seeing the broadest opportunity set in years, which is a good sign for them, with particular strength and excitement too, and growth opportunity for their Aladdin risk management platform and the acquisition recently of Precon. Both, of course, are big software as a service kind of data analysis platforms that are also in high demand by insurers and businesses across many different sectors. So they're liking the way that's going with those as well. And although BlackRock didn't give an update really on guidance, analysts actually raised their guidance on BlackRock based on that strong performance. Anyway, BlackRock had a big pullback in sales and profits coming off the pandemic, where we also saw a pullback in markets that they're heavily invested in. So that kind of dragged them down a little. However, profits are now on the rise again and sales are growing by double digits. So it's looking pretty strong for BlackRock right now moving forward. I would be worried about a possible recession hitting them pretty hard though, and that's probably why the stock stayed about flat this week despite the strong quarter. But for only to be up around 170% in the past decade, I actually think BlackRock does look kind of attractive here. The only reason I'm not buying it myself though is because of the valuation. It's still pretty rich, especially compared to their peers, but they do at least pay a small dividend of about 2.5% with some solid growth metrics on it too. So you kind of have to just balance it out for yourself. Depends on how you really feel about this one, but it's still a pass for me personally, even though I can't understand why others own this giant leader. Moving on to Tuesday, though, we had actually a continuation of big banks reporting with Bank of America, ticker symbol BAC. This is coming off of last week where we had Chase and Wells Fargo report, which, by the way, Chase in particular had a very strong showing, beating analyst estimates with investment banking rising by over 50% and total revenue soaring by over 20%. That's huge for what is already the nation's largest bank. So to still be growing at that rate, that's pretty incredible. Now, CEO Jamie Dimon did warn about the risk of higher than expected inflation, continuing, and as well as our continued high interest rates too. That putting pressure on the economy could possibly lead to a recession. And of course, big banks just banks in general would probably get crushed during a recession. And that would include Chase too. So a little bit of a warning there from America's biggest bank CEO. Now, as for Bank of America, that's the nation's second largest bank, well, their performance was nowhere near as impressive, at least in my opinion, as revenues were almost flat year over year, although EPS at least did beat expectations by 5%. There are some reasons to be optimistic, though, about BAC's future, particularly in their growth that they're seeing from their digital platforms, including their AI virtual assistant, Erica, and the Cash Pro app. both of which continue to see members, user engagement, and transaction volumes rise. The Cash Pro app in particular saw more than a 40% rise in payments, which is very strong. They also saw strength in the Zelle payment platform, which has been growing in popularity. I've been seeing a lot of people using that myself. I even use it myself too. But however, that is not solely owned by Bank of America. Instead, it's actually owned by a collection of 7 of the largest banks. Anyway, off of the back of Chase's strong performance, BAC did enough to impress investors to lift up the stock by over 4% this week, also leaving it up near an all-time high after a very strong past year. As for me though, I prefer Chase for the stronger business and US Bancorp for the bigger dividend, as BAC's financials have really been somewhat flat lately, and their dividend barely yields above 2%, which is a little too low for my taste. They are, however, guiding for double-digit EPS growth in the future, which is very good, and they're predicting that the Fed will start to cut interest rates at the end of this year and continue that every quarter moving forward into next year as well, all of which could help usher in a softer landing to the economy rather than, a hard recession crash. But again, if a recession does ever hit, just keep in mind that banks would be the first to be taking some heavy damage there. So with BAC's valuation already quite a bit higher than the sector, I'd just rather look elsewhere if I want some exposure to finance right now. After that though, we also had United Health report on Tuesday, super popular healthcare insurance company and stock, who is actually the #1 largest health insurance company in the US by sales, and they just continue to put up very strong performance, with this latest quarter being no exception. Revenues rose 6% up to nearly $100 billion, that's crazy, while EPS soared by over 10% as well. Both figures beat expectations too, although it wasn't by much, but they were also dealing with several challenges this year, including a cyber attack that disrupted many healthcare services and ended up costing them billions of dollars as a result. Overall though, UNH continues to benefit from secular trends like the aging baby boomer population that will now see 1 out of every 5 US citizens at retirement age by 2030. And of course, as people get older, they will require more healthcare and insurance and things like that. On top of that, though, investments in AI and other technological advancements seem to be paying off for United, as their tech division, Optum Health, saw the highest growth of all at a double-digit 13% rise in sales, up to $27 billion now, with also operating margins that continue to improve, because of which they reaffirmed full-year guidance, with the stock also climbing by over 10% this week in reaction. Very strong performance. Unfortunately, the stock has already risen up by nearly 600% in the past decade, up to a record high. So I've been a little too shy myself to buy in at these levels, plus I'm not sure how the growing calls of a kind of Medicare for all type of system would impact an insurer like United if that was ever implemented in the future. But with double-digit EPS growth expected annually going forward, a surprisingly still very reasonable valuation, about the same PEG as the sector, and even a little dividend to top it all off, I can definitely understand why so many investors love to own this stock. It is still a pass for me though. But moving on to Wednesday, we had the medical devices and prescription drugs giant Johnson & Johnson report, ticker symbol J&J. Pretty good results from them, 6% rise in sales and a whopping 13% rise in net income, and both figures beat estimates by around 4% each. J&J, of course, spun out their consumer drug segment, Kenvue, recently, that houses Tylenol and other popular brands like that, but it looks like the smaller, more streamlined business is doing just fine without it, in particular with their medical devices and prescription drug segment putting up solid growth. In pharmaceuticals, Darzalex and Stelara both put up double-digit growth and are already doing billions of dollars per quarter each. That's outstanding. While their medical device and technologies business has also been fueled lately, and that really should continue well into the future too, by recent acquisitions of more than $30 billion worth. So they're making big moves to get larger. Thanks to the strong performance, the stock also rose another 3% plus this week. But while it may appear to be an expensive stock trading near an all-time high, the fact is that J&J has actually been pretty suppressed for a long time now, only up 55% in the past decade, with a valuation that is also significantly cheaper than the sector and a 3% dividend that's been grown for over 6 decades in a row too. Even though I don't own J&J myself, I would probably rate it a buy here. I think they're doing pretty well even with the challenging macro economy. So yeah, kind of like what I'm seeing from J&J. After that though, we also had US Bancorp report. This is the other big bank that I own besides Chase, mostly for the dividend. But they saw their stock rise by over 6% this week, despite results that may not look all that impressive at first glance, as sales actually fell a bit in the quarter. But I think investors just kind of felt like the stock was already pretty cheap to begin with. It's about flat in the past 10 years. And the other thing you have to consider is that they are having a bit of a correction year right now after all the growth that they gained last year from the acquisition of Union Bank. So now you have a 2% fall in sales expected this year, but then, a 4% rise expected next year too. So it's kind of leveling out, it's correcting. And for the quarter, they also noted higher credit card volumes and a stabilization in loan delinquencies that are helping them more than expected. Credit card debt is kind of alarming me though. I've been keeping an eye on it more lately, and we just have insane levels of credit card debt. I think a lot of consumers are using credit cards, and I'm a little worried about what that might mean for the future. But might be a little bit off topic there, but just kind of going back here to earnings. When looking at a US Bancorp stock, another thing about them, they also have a pretty cheap valuation. PE and PEG ratio is pretty low. Both are lower than Bank of America and most of their other peers. And they also have a great dividend. It's yielding over 4.3%. That's what I like most about US Bancorp. I already bought my shares though at much lower levels, mostly during the banking crisis of last year. So I'm not looking to buy any more shares at this time myself, but I am glad to see it performing well, and I continue to hold what I already have. Finishing up with Thursday, though, we had Netflix and Taiwan Semiconductor report. So starting with Netflix first, they actually really surprised me here. I've been a little bit of a critic of Netflix stocks, so I gotta admit here that they are starting to look better than I might have given them credit for before. And in this quarter in particular, they saw sales rising by 16%, and more importantly, net income profit soared by almost 40%, with both figures beating analyst estimates too. We're looking at subscribers. Average revenue per user rose 7%. That's thanks to price increases and a crackdown on password sharing, while subs still put up 16% growth even despite that. You might expect subs to be going down. Well, they had 16% growth. That helped them a lot too. And it's slowly approaching 300 million. And it already makes them the second largest SVOD provider in America, pretty much tied with Amazon there, according to Statista. Although I don't think Amazon actually releases those numbers, so I would bet that they're probably a lot higher. But either way, it's an impressive feat for Netflix. And of course, they're just like really dominant there. Anyway, they've also been trying their hardest to diversify as much as really they can within just streaming itself. And they've been adding things like live events. You've got the upcoming Paul versus Tyson fight that's been delayed, but I'm pretty sure that's still on. It's going to happen later in the year. They've also been doing stuff with the NFL. They're trying to do other like TV programming, and they've even added a ton of video games too. I personally still prefer though much more, I would say, the vastly larger and much more diversified businesses of companies like Amazon, Disney, Apple, or even Google with YouTube, who all give me that exposure to streaming, but are still, going to be much larger, more diversified, and have so many other things going on with them to where, if streaming struggles, they still got everything else lifting them up. So I prefer those a lot more. Now, I will say though, I gotta admit, Netflix is looking pretty good so far though, but the stock actually for the week, it actually fell a little, which is a little surprising, but I think it's really because it was trading already so high, near a record high. It rose by so much recently, and yet what is also kind of surprising, though, is that the valuation is still pretty cheap thanks to their huge EPS growth of more than 20% a year. Seeking Alpha puts their PE much higher than the sector, but their PEG is a bit lower. And again, that's just because of the growth that they're still expected to have in the future. It's still not a stock that I'd want to own myself, though, but for how isolated they are within streaming, I actually think they're doing just about as good of a job as they can do right now. Anyway, finishing up with the last stock, TSMC, Taiwan Semiconductor, ticker symbol TSM. This is a huge semiconductor manufacturer for other companies like Apple, Nvidia, AMD, and even Broadcom. And they continue to see huge demand from AI, especially from Nvidia, but also just thanks to their innovative technologies. I mean, they've got 5 nanometer, 3 nanometer. Now I believe they're even working on 2 nanometer chips. They're making those too, which are, I would say, TSM's chips are always just kind of ahead of the curve. They're always much more ahead of the competition. I always see everyone kind of trying to catch up with them, and that's really helped them continue to grow. They're always putting up pretty big numbers. TSM, in this latest quarter, they put up 35% growth in sales, while net income profit rose by almost the same amount too, with AI now representing over half of all their revenue, which is up 28% in the quarter as well. Now, unfortunately, smartphone revenue still makes up about a third of their business, and that actually declined a little in the quarter as there just hasn't been a lot of smartphone demand lately. So that, coupled with some other issues, some geopolitical tensions and fears going around, it's causing investors to be cautious with this one. Of course, you have the threat of China always right there with Taiwan. But on top of that, recently presidential candidate Donald Trump recently said that he wants Taiwan to start paying for protection since they took nearly all of America's chip business. So maybe not the friendliest kind of comments towards Taiwan or their businesses, right? Like Taiwan Semiconductor. I don't think it's that big of a deal, but the headlines kind of ran with it. And I think that's spooking investors a little bit right now, who surprisingly actually sold the stock down over 12% this week, despite what I thought, again, was a very strong quarter. I wouldn't be too worried about all this stuff, though. TSM continues to be the strongest player in the game, and they are currently receiving like billions of dollars in subsidies to build new plants in America too. So I think you'll continue to see growth from expansions as well as a rise in demand for AI chips too. And they've been expanding in other areas too, so there's a lot to kind of look forward to with TSM. But as it stands, the stock does still trade near a record high after skyrocketing this past year, and it's up over 700% in the past decade. So I'm personally waiting for a bigger pullback if I can get one before buying in. I actually used to own TSM in the past. I had sold it for a nice profit, but kind of regretted not holding it because I would have made even more profit. Anyway, PEG ratio right now, it's around 1.5. I actually think that's still pretty reasonable for the 20% plus growth you get in EPS expected over the next 5 years. So it's not a bad stock to own in my opinion. I will be keeping a close eye on it myself. Anyway, that'll do it for this week's update. Let me know your thoughts on everything that we discussed. I hope you enjoyed this update video, and make sure you tune in next week for another fresh roundup. Anyway, thanks for watching. Thanks for your support. I hope you're all doing well, and I will catch you in the next video. All right, take care, everybody. Bye-bye.